So for more on that story, let's bring in Steve Sosnick, the chief strategist over at Interactive Brokers. Steve, you just heard Steve's report on the Fed and the way that they're maybe thinking about the way the interest rate outlook is going to shape up. Inflation, jobs are still a problem, but we're much more focused on jobs. How does that compare and contrast to what the market is telling us about the overall macro picture?
Well, I mean, from Friday on, when John Williams, said that he's in favor of a cut, the market has completely changed its mindset. The mojo has changed. The whole mood has changed. Now, but again, to some extent, we were enthralled to certain various risk-off types of trades, and those have abated. You mentioned Bitcoin, that nasty correlation, which was in many cases powering some of the negative move. But I think now that we're seeing rate cut expectations improve, so is the market, and that's understandable and that's quite fair because that is a fundamental that does tend to move stocks. I'm happy when the market moves higher on fundamentals. I'm not necessarily quite so happy when it just doesn't, when it just sort of does its own thing without regard to what's going on around it.
Over the last several weeks, I've asked the question, and I think many of our reporters and anchors here at CNBC have asked the question of various guests about whether or not the Fed needs to cut rates in order for the market to keep going higher. Based upon the reaction that we've seen over the last week or so in the markets, it sure as heck appears as though the market needs a Fed rate cut to keep going higher. Does that Fed variable still need to be tilted towards rate cuts in order for the catalyst to be to the upside?
Yes. I mean, the question is, does the economy need the rate cuts vis-a-vis does the market need the rate cuts? We could have that conversation with someone like Steve Leisman for hours. But, again, they're navigating in the dark, and they're deciding that the Fed is deciding that, all right, we're leaning toward, caution rather than not. And the stock market likes it. We had a rough November as rate cut expectations fell from relatively high numbers, 80 or so, to about 35 or so, 30, 35. Now we're back closer to 70, 75 or more, and all of a sudden the market's in a much better mood. So, yes, like it or not, the stock market is very dependent upon that. Maybe I should create a VIX for rate cut expectations or something, but they've been volatile, and so has the market.
And we could look at the MOVE index in terms of bond volatility to get some of that kind of inkling about it. The AI trade has been a powerful force in the market so far. And maybe that rate cut story has to interplay with the AI trade as well. But you mentioned some of the correlations between even cryptocurrencies and the NASDAQ and the S&P 500. How does that play out in your mind from a strategy standpoint? Is this market well positioned for a next leg higher? Or is this a consolidation phase that becomes wait and see about what the future catalysts are?
The market had a bit of a paradigm shift over the past few weeks. Some of the moving averages that we'd come to depend on, the 50-day started to turn lower. We broke through the 50-day with some vengeance. We actually got through the 100-day a little bit, but we're back above that now. What are the reasons that I see Bitcoin correlating with first the NASDAQ and then to a larger extent with the S&P 500? Because NASDAQ and the S&P 500 correlate well because it's the same
Mag 7.
It's the same Mag 7 moving both of them. And I do see that as a proxy for risk among a lot of investors. And the reason I say that is a lot of people got into crypto this year who weren't your 25 and 30-year-old hodlers, the people who just were true believers. These were what I'm going to call crypto tourists. They were able to get into it because of ETFs. It broadened the exposure. But as a result, to a lot of these other investors, it's just another investment. And if it's not performing, it's easier to get into. It's also easier to get out of. And so I think that's why that sentiment spilled back from one to the other. The difference is in a lot of crypto situations, not the ETFs, but in crypto itself, you have so much more leverage, so it can be much more susceptible to downswings. Remember, if you're leveraged 20 to 1, 5% move wipes you out. And so you do get those situations.